Following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And we are talking about money here on The Answer. The Answer about money. That's what we're doing today here on Saturday. We've got a lot to cover today. I've got a guest today. The company was on the radio 9 years ago. 9 years ago this month. They've made a lot of progress since then. You want to hear what they have to say because almost everyone that's listening can use their product, and it makes sense to do. He's coming up a little bit later in the program. Also, I want to talk about surveys, about financial advisors, performance, and regulators. All that rolled into one. That's coming later in the program. But I want to start. 2006, I sent out a newsletter. Now I send out e-letters and not newsletters, but I sent out a newsletter at that time about the housing market because I'd sat on an airplane going to a conference in Phoenix, sat on an airplane next to a guy who was flipping houses. He was flipping houses in the Phoenix area, around the Arizona. And he was telling me that in the beginning when he started to flip houses, what he would do is he would have a house built, he would let somebody rent the house, and after 2 years he would flip it. But that wear and tear of 2 years and somebody living in it actually deteriorated the value of the home. So what he was doing at that time in 2006 is he was building 15 or 20 houses or how many ever it was, and letting them sit for 2 years and then selling the house and making a really, really good living. So I sat on the plane and listened to this whole story roll, and I knew there was something really wrong. So I came back and I wrote a newsletter about that, about what was going on in the real estate market. And I said, with what's going on, I believe we're going to face a crunch, a credit crunch. I never saw the crisis. Well, I didn't see the crisis until 10 years ago. But I changed a few portfolios around for a credit crunch. But 10 years ago, my wife and I were doing every baseball park. Not every baseball park in 1 year, but a couple a year. And we happened to be in September of 2008 in New York City. We went to Shea Stadium. We went to Old Yankee Stadium. But our hotel was a block away from Lehman Brothers headquarters. It's a magnificent building, by the way. If I could pick a headquarters building, I think I would pick that. Can't afford it at all. Lehman Brothers couldn't afford it either, but that's another story. We watched the whole thing go down. Watched Lehman Brothers, and sitting in front of Lehman Brothers, you had a number of limousines, probably 2 or 3 limousines parked in the street blocking traffic. No one really cared. There were a number of taxis thereby. You had all of the media around, the TV, the radio. They were all around. And coming out the back of the building, you had these young guys in their 30s and 40s in their white shirts, no ties. They were carrying out those Pendaflex or the big folding folders full of papers, and you could see from their faces things were really, really desperate. We watched the whole thing happen. It was almost more fascinating there than going to the baseball parks. And of course, on that Sunday night in September 2008, Lehman Brothers filed for bankruptcy. They couldn't sell the company. And on the plane coming back, I said to my wife, we're not in a credit crunch. We're in a crisis. It's now been 10 years since that happened. That started, or was, the culminating event, the catalyst for the Great Recession. There have been a couple books written about it. Gary Gorton, who was part of the Federal Reserve, part of Wharton, part of Yale, wrote a couple books called Slapped by the Invisible Hand, The Panic of 2007. He also wrote a book called Misunderstanding Financial Crises, Why We Don't See Them Coming, Why We Don't See the Lessons. Tim Geithner wrote the book Stress Test. And I've visited this a number of times on the radio since 2009, 2008, but I think it's worth revisiting because a lot of times investors look back and try to prevent what happened with a rearview mirror. Instead of looking forward, looking out the windshield and looking at the highway ahead, we tend to look in the rearview mirror. So it's worth looking at exactly what happened to cause the Great Recession, what we went through with the Great Recession, and then think about it in terms of where we are today and what the probability is that we're having another Great Recession, what the probability is we're going to face another issue. The panic we went through, and what we went through in 2007, 8, and 9 was really what was called in the old days a bank panic. You know, the new thing is to put a new term to it and call it a systemic problem. But what we went through was a bank panic. We hadn't seen a bank panic since 1934. We went 70 years. What was called by economists the golden period. Economists believed we would never go through a Great Depression, would never go through one of those again. They really didn't foresee what was going to happen. We'd gone through these times before. 1796, we went through it. The first Great Depression happened in 1834 and was repeated in 1848. We saw a panic that happened in 1874 that not only happened in 1874, but we went through 6 panics. 1874 to 1907, when the Federal Reserve was finally formed. And then we had the Great Depression, of course. Sherlock Holmes, you could almost say, you see, but you do not observe. It's the same thing as the negatives today. I keep hearing about the end of the bull market, but it doesn't happen. We keep hearing about things getting worse, but it doesn't happen. You know, the one great difference between the Great Recession and a lot of the reason people didn't see it is that in previous panics, it was visible to everyone. But in 2007, what was happening was really only visible to insiders. Most people had never heard about the markets that are involved. They didn't know how they worked or what purpose they served. People didn't know about credit default swaps or repos or CDOs. In previous panics, what would happen is people would get the idea that a bank was going to go under and their savings were at risk. We didn't have an FDIC. Their savings, if you put your money into the bank in 1910 and that bank went under, you lost your savings. So what would happen is when people got worried, they would go to the banks and want their money out. It was a run on banks. 2007 was no different, except it wasn't the individuals that did the run on the banks. It was other firms that ran. And by the way, I want to say politicians are not regulated, and regulators and journalists are not experts at all of this. They couldn't see it any more than you and I did. In previous runs, banks would have the cash. They would loan if you deposited $100, they would keep $3 or $4 in reserve, and they would loan $95. So that if there was a run on the bank, they only had a few dollars to cover that run. Now, if it was just one bank, what would happen is they would get the cash from other banks, show that they could pay off their depositors. And usually the depositors would see that their savings were okay, they'd bring it back. But if it was all the banks in the city, and usually runs started in New York City, they would not have enough cash to cover it and would have to close the banks. In 1934, the Federal Deposit Insurance Company was formed, and deposit money was guaranteed by the U.S. government for up to $100,000. And for 75 years, there were no panics. In 2007, it was not a classic panic. It wasn't individuals that ran the banks, but it was other firms. Firms with large cash, hedge funds, pension funds, some banks, credit unions, college endowment funds, firms with large cash. A firm with $500 million in cash was not going to be covered by $100,000. So what they wanted for banks to do is to guarantee their deposits. And the banks guaranteed those with repos. And those repos consisted of CDOs, securitized debt obligations. And when problems began and the CDOs began to drop in value, people began to demand more and more coverage for the deposits they had. And the run had begun. We're going to come to a commercial break, and I'll finish the story, and then we're going to get to our guest, which has a much more happy story than we're talking about now. So don't go away. We've got a lot to cover, and it's really important that you hear what we have to say. I believe we're not going to go through another Great Recession, and I'll tell you why. That's coming.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about Lehman Brothers. 10 years ago, Lehman Brothers went down. That was the catalyst of the Great Recession. We had a bank panic. We had a bank run. We had a run on the banks, not by individuals, because the individuals were covered by the FDIC. For 75 years, they didn't see the reason to be worried about their savings. But firms with huge amounts of cash, 500 million, 100 million, they wanted some guarantees of their money in the bank that they were going to get it back. And those guarantees were things that most people had never heard of. Repos, CDOs, subprime mortgages. Those all were the guarantees of cash in the banks. And when those values began to drop, the run began. Remember, at that time, share prices of banks and share prices of brokerage firms were dropping. They were dropping dramatically because you didn't know what was going to happen. And then Lehman Brothers filed for bankruptcy. And people that had, firms that had money at Lehman Brothers were not in any way assured they were going to get their money out. One thing that happened with Treasury is the Treasury guaranteed all the money going back to the firms. Had that not happened, the firms would have demanded their money back, and it would have driven prices down further. The Lehman Brothers, 10 years ago, a big, big event. How bad was the Great Recession? It's 5 times worse than the shock of the Great Depression. 5 times worse. The bond spreads were twice what they were in 2008 and 9 than what they were in 1929. $15 trillion of household wealth disappeared in the Great Depression. 9 million people lost their jobs. Unemployment hit 10%. I mean, the Great Depression, it hit 25%, but 10% was a large number. And most people, a lot of people, were worried about losing their job. The natural instinct was not to do anything that was unpopular, to let the fire burn itself out. 1874, we have an example of what happened. 1874, they let the fire burn itself out. It took 30 years. 30 years, like 2008. Every other year was a recessionary year. It had a very damaging effect. We don't have the numbers, but people estimate that unemployment in the 1870s to the 1900s was 20%. It was huge, significant impact. The central bank was formed, the Federal Reserve, to be the lender of last resort, and that's what happened. We went 75 years without a panic. Are we not going to have another panic? Are we not going to have another Great Recession? I believe that we will, but I believe that right now, where we stand, it's not imminent. The banks have higher levels of capital. Going into the Great Recession, banks were trading for their own accounts. Banks were losing money sometimes in their own accounts. Banks had low levels of capital. The Treasury came out and required banks to increase the amount of capital or sell themselves. And a lot of banks did sell themselves. We were seeing borrowing, worldwide borrowing, reach unprecedented levels. And that borrowing was based oftentimes on sub-lending standards. We're not seeing that so much anymore. And we're not seeing the securitized debt, although we're beginning to see some securitized debt come back into effect. It was not at the level today that it was then. What is fresh is what we went through in the Great Depression. We have unemployment, which is low. Great Recession time, 10%. Corporate profits are running high. We're seeing wage pressure. Companies can afford to pay higher wages now because they're making more profits. When you look at it, inflation is about 2/3 caused by wages and 1/3 by commodities. Wages are now rising. Commodity prices are increasing. That's the underlying scenario for inflation. When we hit the next recession, and we will hit another recession, the reaction may very well be to look in the rearview mirror and remember what happened in 2007 and 2008 and 2009. The idea will be to respond much quicker, to respond by pumping money into the economy like we did with TARP in QE1, QE2, and QE3, because all those worked in the Great Recession. But the conditions are very different. At that time, there was 10% unemployment. We had a credit crisis. $15 trillion had been lost in household net worth. If you pump money into an economy with 5% unemployment and wealth only down maybe $1 trillion, what happens is you shift not into a reversal of a Great Depression, you shift into stagflation. We experienced that in the 70s. Same conditions, same thing going on. My guess is that's the next crisis we'll face. That's looking at the highway going forward rather than looking in the rearview mirror. That's where we are. I think it makes sense to review this every couple quarters or once or twice a year, just to keep in mind that that's the rearview mirror. What we need to worry about with our investments is the highway ahead. Talking about highways ahead, maybe you want to figure out where to meet people. That brings me to my guest today. My guest is Chris Ruff, the head of Glimpse. I don't know the exact title. Tell me the title. Welcome to the program, Chris.
I'm really excited to be here. Thank you. I'm Chris Ruff. I'm the CEO and president of Glimpse.
Welcome to the program. So it was just 9 years ago, actually, September 18th, 2009. Actually, at that time, we were just coming out of the Great Recession. I had a program on gold, of all things. Gold was at $2,000 an ounce. The ads were coming out saying gold was going to go to $5,000 an ounce, and I was coming out and saying I thought it would reach 1,000 before it reached 5,000. It may still reach 1,000, but it never got anywhere close to 5. And then we had Glimpse. So let's get an update on what's going on. Let's start, though, with your background.
Yeah, so I've been in tech most of my life, particularly focused on B2B enterprise solutions, though most of the time those companies focused on big consumer ideas. So the company I ran before which today is called Zevo. It used to be called UI Evolution. We did all kinds of B2B to C business with connected car, in the very early days of mobility, lots of smartphone applications. We just happened to partner with other enterprises to deliver them. So I have lots of experience in that area.
And now you've been with Glimpse for how long?
So I'm having my 1-year anniversary. Okay. Like I say now, all the problems are mine.
Okay. So tell us what Glimpse actually is.
Yeah, so at our core, what we are is we're a location sharing platform. We use location as a communication method to help people communicate with each other and businesses to communicate with consumers.
So let's make it a practical. I have Glimpse on my phone. You have Glimpse on yours. If we want to meet, how do we do that?
Yeah, it's really simple. I basically send you a Glimpse in one of two ways. One way is the easiest way is using a messaging platform. So it'd go like a text message with a link. That link then gets, the user clicks on it, which opens the app on their phone. So you'd open it on your phone, and you'd immediately be accepted into seeing my location for as long as I'm letting you see it. The powerful part of what we do is the whole vision of our company is based on temporary, secure, private location sharing where the user is in control. So if I am meeting you for lunch in a half hour, I can stop my location sharing in 30 minutes.
So, but in the meantime, I get to see if you're on your way.
Absolutely. We actually minimize the other types of communication we need. You know, if you don't use Glimpse, what you end up doing is you and I are exchanging maybe 3 or 4 text messages where I'm trying to estimate how long that I'm going to be before I get there. If you use Glimpse, you can say, I'm going to be here in 10 minutes because Glimpse does all the hard work of ETA.
And on top of which, if you're driving to meet me, it's not very safe to text back and forth.
Yeah, Glimpse is really much safer. And in fact, we're partnered with almost every auto manufacturer in the world to even make it even simpler by allowing integration to the head unit of those cars to simply send a Glimpse.
And so people know when you're coming. I don't know how often I go to lunch every week, 2 or 3 times. And sometimes I'm sitting there all by myself wondering where my guest is, wondering if we screwed up on our communications and I put it in my calendar wrong or they put that in their calendar wrong. So you can sit there for 15 or 20 minutes and not know where your guest is. But with Glimpse, you can see.
Yeah, the thing we're seeing in the world change is people, they want the access to information. I mean, whether it's personal communication, where now you'd feel more comfortable maybe making a phone call before I show up or doing something else, or even more importantly, we're having great success working with Fortune 1000 companies, helping them improve their service. So if you've got a 4-hour window with your cable service provider, Glimpse can actually narrow that window and you'll know precisely when your service will be provided, really taking the anxiety out of the whole service experience.
Let's talk about that a little bit. 4 hours. Usually if you have a cable company, a Comcast or whoever it might be, and you have a repair to make, or a service technician coming, they will give you a 4-hour window. So you sit home for 4 hours or sit in your business for 4 hours waiting for somebody to show up. There's things you could be doing during those 4 hours, but you can't go out and do it because you're waiting for this guy or this woman to show up.
Yeah, the value of what we provide is, initial estimate, we don't really lower the estimate of that because we won't know how the day is going to happen for the service, the tech.
Okay, we're going to come back and finish that thought very, very shortly. So don't go away. You want to hear how they approach this. It makes all the sense in the world. So we'll be right back and be talking about Glimpse.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm here with Chris Ruff, the CEO and president of Glimpse. We started to talk about Glimpse. We talked about one of the big issues I have is when you call a service technician for a problem because your cable isn't working at home and they give you a 4-hour window. You sit around for 4 hours twiddling your thumbs, doing nothing. You could have gone to the store. You could have done any number of things. But you have to wait for 4 hours. And if the technician is late and you leave, they show up 10 minutes after you leave, it's like having a toothache and going to the dentist. The toothache always disappears when you get to the dentist. Anyway, let's talk about, because Glimpse solves that problem.
Yeah, we're seeing a real market shift today in e-commerce and service providing to the home. There's just a huge expectation being set by companies like Amazon to have way more transparency of information to the consumer. So this cable problem, by the way, that has existed forever, there's finally a real dramatic need by the consumer to get that information. They have other options of entertainment, using cable as an example. If the service is poor, or you're waiting and waiting and waiting, you may cut the cord and move on to Netflix. What we do is we narrow that window. So we may not know in the morning when your appointment will happen, but as the day goes on, we narrow the window until we finally give you an accurate ETA and a live map where you can, just like Uber, watch the service tech come to your home. Consumers like it so much. One of our customers in Europe had one of their consumers go out and save a parking place in London so that the tech would have a place to park. So if you think about the power of that, your customer's helping you serve them.
Yes.
So different than annoyingly waiting, tapping your foot,
Yes.
or while you're waiting and wanting to move forward.
And you begin to get really upset if somebody is late. Now you know if they're going to be late.
Yeah, we want people to value our time, right? And what Glimpse does is we don't take away the waiting for the appointment. What we do is we make people feel more secure it's going to happen. They know if they're 5 minutes late to wait, because you don't want to wait another 4 hours 2 weeks from now, right? Mm-hmm. And so you take away all of that and you create a real transparent way to communicate between the business and the consumer that's becoming not just a nice to have. It's really a market expectation.
So in the beginning, nine years ago when you started, it was a person-to-person connection. What you're talking about now is a business-to-consumer connection. So talk about that a little bit.
Yeah, I mean, what we've evolved into is really an omni-channel, consumer to consumer, but also business to consumer and consumer to business. One of the new initiatives we're working on now is something called buy online, pick up in store. I think we've all gone into retail experiences where now Nordstrom's taken away part of their retail storefront where they don't have inventory, and they've set up shelves so I can walk up and pick up things that I bought online. With Glimpse, what we're trying to do is make that transaction seamless as well. There's problems like in the grocery industry where they want to deliver the order, but what if you have ice cream? What if you have a roasted chicken? You want to actually pick that the moment the consumer gets there. And if the consumer has to wait, they could have shopped themselves. So Glimpse becomes a powerful platform for the consumer sharing even with the business. So we can tackle business to consumer, consumer to business, and consumer to consumer. We really are an omni-channel play for location sharing and power around that.
It sounds like it's gone through a tremendous evolution over the last 9 years.
Oh, yeah. I mean, it was interesting talking about 2008, 2009. That's 2 years into the iPhone. Apple was far from $1 trillion company. So much has changed, and just the expectation on applications and services have been completely redefined. And Glimpse today, a pioneer in this mobile space on smartphones, has evolved into the industry leader in location sharing, and now really bringing tremendous value to business and consumers.
9 years ago when Glimpse was on the radio program, I had a Palm Pre. I had one of the first Palm Pre's. I had the Palm Trio. I had the Palm all the way through. And the Palm Pre, I can remember when Brian talked about Glimpse, and I said, when will you do it for the Palm Pre? Never happened.
Yeah, the founder made a wise decision there.
He did. I mean, the Palm Pre went away a long time ago. Should have gone away. I should have made the transition to something else before the Palm Pre. But at that time, you were just beginning to connect people on different devices. Today, you connect people on devices. Is it device dependent?
No, in fact, one of the powers of Glimpse is we're both device independent, so we can run on virtually any device. Today we're running on smart refrigerators from Samsung, smart televisions in your home, I had mentioned all the major automotive contracts we have where you can get Glimpse in the car, as well as obviously you can get Glimpse on the smartphone, and that's the best way to get it. So you can go out to Apple, go out to Google's Play Store, and download Glimpse. That's the best way to get it. But we're also ecosystem independent. So if you're an Android user and I'm a Apple user, I can share a Glimpse with you, and it works seamlessly. And if Google has a product that shares location, it's really in the Google family. And if Apple has a product, it stays in their family. So we're really the universal way to share location, and that's really what differentiates us in the market.
So suppose I have Glimpse and I want to track somebody that does not have Glimpse. Can I do that?
Yeah, absolutely. And you don't even need the app. For most of the solutions that we provide, we can get location from other ways. And also when the cable service tech is providing their location, we can provide it all through a web view. So even if you don't have Glimpse, you get a notification and you open up a window that looks like your cable provider. Our favorite one in the U.S. is Charter. And then you can track the entire experience without the Glimpse app.
So tell people how they do download the Glimpse app. How do they get involved with this?
Yeah, the best way to do it, go to glimpse.com, and there's a link they can take you to all of our links on the App Store, or obviously just type in Glimpse with a Y into your mobile phone browser and App Store, and you will be taken to the app and download it, please. You will not regret it.
So say, again, Glimpse is spelled with a Y.
Glimpse with a Y.
Spell it for us.
GLYMPSE.
Perfect. So it's well worth doing and loading and tracking.
Absolutely. It makes life so much easier, the way you communicate with your friends and family. I have a teenager on her way home at night with her curfew. She sends me a Glimpse.
So if she's tied up in traffic.
Exactly. And I rest assured, and if she's a little late, we don't have as tense of a conversation about missing curfew.
And how about children who don't drive?
Still great. I mean, my teenagers who are constantly waiting for me to pick them up, who usually call me 2,700 times before I get there, I send them a Glimpse, and they can track my ETA that says I'll be 5 minutes late. Everybody relaxes.
Yeah. It works for family. It works for business. It works for so many things. Thanks for being on the program.
You're welcome. Thank you.
It's a great, great story.
Thank you.
I want to shift now and talk a little bit about Seattle Magazine rates doctors every year. You know that? Get the Seattle Magazine, it rates doctors. What they do is they send surveys out to other doctors, and they ask if they had a relative with a given problem, for example, a herniated disc, to which doctor would you send your relative? Who would you send them to? And then they accumulate all those surveys, and they get a professional rating, so they know which doctors would be recommended by other doctors, professionals. It used to be done with financial advisors too. The survey used to go out to 25% of high net worth households, asking them for nominations and evaluations of people that they actually knew and had worked with. In addition, they would get the same information from peers. They would send it out to financial system professionals. They would ask them, who do you personally know? Not people you've heard about, but who do you personally know in the field as an advisor who deserves special recognition, who does an outstanding job? And then they would get professionals in the financial services industry into a blue ribbon panel and do a blue ribbon panel. They would review the history of the advisors, and then they would pick the top 20% of all advisors. There were a limited number who qualified. That was the way they used to do the 5-star wealth management program. And then the regulators in 2013 came in and said, that's really a testimonial. And testimonials are not allowed in the advisory business. And there's a reason for that. There really is a reason for that. Because if people are using testimonials, They can put up a testimonial ad of a person who thinks you're great, or a friend or a relative that talks about how well you've done for them. And in fact, you've got a whole lot of people who you didn't do well for. So the regulators have outlawed testimonials, and they considered that award, that 5-star management award, a testimonial. And we're going to come back and talk about it. Talk about that. We're going to talk about what goes on in the Department of Financial Institutions exams and performance. I think all those things are related. We're going to talk about those. So don't go away. We've got that to finish off. If you miss any part of this program, if you'd like to hear more about Glimpse, if you'd like to hear more about the Great Recession and what my thoughts on that, you can find it on our podcast, YouTube, and you can also like About Money. You can like us on Facebook. You can listen to our tweets. We'll be right back after the commercial break.
More About Money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm back. Do you remember when tweets were something that a bird did? You could actually listen to them. Yeah? I know. As we were going off for the commercial break, I said you can listen to our tweets. Actually, the tweets come on they're Twittered. Oh, anyway, it's by Twitter. Remember when clouds were something in the sky? When apps were something you filled out for a job application? You know, the words have changed. When Glimpse was something that you looked at. Anyway, all that's coming up. I want to come back to this idea. The 5-star management program. DFI came in. Department of Financial Institutions for the state of Washington said, wait a minute, the way you're doing this is wrong because that's a testimonial. What we want to do, what we would like you to do, we're going to change the criteria. First of all, we want complete disclosure. We want it on. If you have one of these awards, we need you to display and talk about the criteria. We want you to disclose any facts that would question the validity of the award. We want you to disclose whether you had any unfavorable ratings that didn't show up in the survey. We want you to clearly disclose the category in which you are. I'm in investment management. I want you to disclose that past performance is not indicative of future performance. And I'm going to talk about that in a minute. I want you to disclose that Crescendo created and conducted the survey, not Seattle Magazine. We want you to disclose if you paid any fees to Crescendo. And I didn't, at least. And we want you to disclose all the requirements. That you're actively employed as a credential professional for a minimum of 5 years. That you actually are credentialed. You have your Series 65. I don't know of a single financial advisor who got one of those awards that wasn't credentialed. But anyway, you have to disclose that. You have to say that you have a favorable regulatory and history review. You have to say that you fulfilled the firm review process based on internal firm standards, and you have to be willing to accept new clients. The criteria includes looking at 1-year client retention, 5-year client retention, whether you do discretionary or non-discretionary client assets, how many households do you serve, and what your educational and professional qualifications and designations are. You know, I qualified through all those for a number of years. But what's the difference? What do I find problematic? Think about the criteria. 1-year client retention, 5 years client retention, discretionary or non-discretionary. How many households do you have? And what are your educational and professional designations? What does it say about performance? Not a single thing. What does it say about how well you do for your clients? Not a thing. You know, you can calculate the probability of outperforming or performing as well as the Standard & Poor's 500. If you look at the statistics, an advisor can, or a money manager can outperform or do as well as the Standard & Poor's 500 for any given year, about 1 in 4 at a maximum. Sometimes it would be 1 in 7. For 3 years, the numbers run from 1 in 8 money managers to 1 in 14. Morningstar did a study and looked at 3-year and past performance being no guarantee of future performance. Think about it as a coin flip. You can flip a coin twice, and 1 out of 4 times you're going to come up with 2 heads. Flip a coin 3 times, and 1 out of 8 times you'll come up with 3 heads. But what are the odds that somebody can do as well as the S&P 500 or better for 10 years? The odds are 0.00097, or about 1 in 10,000. Flip a coin 10 times, and how often will heads come up on every flip? About 1 in 10,000. Same thing for somebody performing as well as the Standard or outperforming the Standard & Poor's 500. Eugene Fama of the University of Chicago got the Nobel Prize, or shared the Nobel Prize in 2013, saying 7% of money managers can do that over a 10-year time period. 7 out of 100. That's a lot better than 1 out of 10,000, which really means that there's a skill involved. It's not chance. For outperforming or doing as well as the Standard & Poor's 500 in 3 years, that's something that can happen by chance. And so there's no guarantee that performance will be repeated. What happens when you have 10 years? That's significantly different. 13 years? It's 1 in 100,000 chance. The mantra at big brokerage houses is to sell the relationship and not the performance. There's a reason for that. Over 10 years, if you have 10,000 brokers, financial advisors, only 1 will be able to do that, statistically. 9,999 will miss the mark. So doesn't it make more sense if you're a big brokerage firm to sell the relationship and not the performance? I went through training with Payne Weber. 1986, we spent 6 weeks. Of those 6 weeks, we spent less than 4 hours on stock picking and 0 on portfolio management. Out of that time, over 100 hours was spent on how to find clients, how to sell clients on your services, how to sell the relationship. That's what training was. That's what training is today for financial advisors. But since 1987, there's been a big push to do financial planning, traditional financial planning. If you listen to the program very long, you know that I don't have a great deal of faith in financial planning. I think mathematically it doesn't make sense. If you have stocks that return an average of 9%, bonds that return an average of 5%, did I say it right? Stocks at 9%, bonds at 5%, cash at 1%. When you add those together, you get an average return of 5%. What does that do over 25 years? 100,000 in the stock market at 9% will grow to 800,000. At 5%, it'll grow to 330,000. You know, emotionally, it sounds really good to do a financial plan. You have all sorts of graphs and charts, and it shows how safe you are. The reality is, you are giving up a huge amount when you do that. You know, there's a lot of things that go on in my industry, but very few people actually publish their returns, actually look at their returns, and there's a reason for that, because most people underperform the market. They don't want to put their returns up. the firms don't allow you to put your performance up. It's something that you need to ask about. You know, one comment that I made the other day is when you underperform, if you're on a baseball team, if you're the manager of a baseball team and your team is a losing team, they don't ask you to take a lower fee. And there's a compression of fees in my industry because of underperformance. But they don't ask a manager to take a lower salary. What they do is a poor performing manager of a baseball team is fired. The manager of a poor performing football team is fired and replaced. You know, it's only in my industry where they say you should sell the relationship, not the performance, and maybe take a lower fee if you don't perform as well. That's the way it is. I will be back next Saturday with another insight into what's going on. Until then, have a great weekend and week.
Listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.